Welcome back. You arrived at lesson 8 of the Value Investing Bootcamp. This will be a more hands-on lesson with practical info on how to calculate the absolute value of a company. This absolute value is more often referred to by value investors as the intrinsic value, and so from now on we will use this term instead. Every investor must learn to calculate the value of a company in order to know a bargain when they see one. However, there is no simple formula for this. Let's see why that is. While stock prices are quoted on a per second basis and therefore known to everyone, the intrinsic value of a company is less tangible and will always be an estimate based on numerous assumptions. For example, if investor A believes company X will grow its earnings at a rate of 10% for the coming 5 years, investor B might think the earnings growth rate of company X will be no more than 5%. So investor A thinks company X will earn more money in the coming years compared to investor B's estimate. This means that investor A will put a bigger value on company X than investor B. So who is right and who is wrong? Well, they are both right, at least until one or both of them is proven wrong by the actual future performance of the company. In other words, it is impossible to determine the exact value of a company with complete certainty, because the value is based on projections of future growth and other assumptions. For example, intrinsic value calculations assume that the reported earnings and cash flows of a company are correct. However, these numbers are merely the best guess of an accountant. They are not 100% foolproof. Therefore, the intrinsic value of a company is merely an educated guess based on thorough fundamental analysis. But this is fine. You don't need to know the exact value. An estimate is all you need. Or, as Warren Buffett's business partner Charlie Munger once said, "It is better to be roughly right than precisely wrong." But if the future is unpredictable, and there is no way to know in advance whether your assumptions are correct, how do value investors protect themselves from making huge mistakes? The one and only answer is conservatism. By using conservative inputs and by only buying stocks at a massive discount to intrinsic value, you build in a margin of safety, which allows you to make money even if your estimate proves to be inaccurate. Margin of safety is a key concept, which we will cover in greater detail in later lessons. But for now it is sufficient to understand that conservative estimates are easier to meet or exceed and minimize your chances of losing money at the same time. Being conservative means you might miss a few great opportunities, but it is the only way to protect yourself from major losses. So how do we calculate the intrinsic value? There are actually several methods available, and none of them is perfect. Therefore, your best bet is to combine the results from several methods to get a value range, and then lean toward the more conservative estimate. I will describe the theory behind some of these valuation models in the rest of this lesson. For a detailed, practical explanation and actual formulas and calculations, I refer you to the extra material to this lesson, which is the ebook How to Value Stocks. This ebook covers 3 distinct valuation models: the PE multiple, the discounted cash flow model, and the return on equity valuation model. While we describe this metric in more detail in later lessons, some of you might already wonder why book value is not mentioned as a way to determine the intrinsic value of a company. The reason is because book value is an accounting term which often significantly over or understates the true value of a company's assets. What something cost in the past is simply not a good measure of its value today. For example, if a company paid $1,000 for a laptop 3 years ago, that laptop will not be worth $1,000 today. It will be worth a lot less. On the other hand, if a company has bought a piece of land 20 years ago, it will most likely be worth much more today. Still, the original purchase price is what is reflected in the book value. Therefore, book value cannot be used to estimate the intrinsic value of a company with any degree of accuracy. Many valuation models project earnings into the future and calculate the intrinsic value estimate based on those projections. However, $1 today is worth more than $1 in the future, because that dollar could be earning an interest rate if you would invest it today. This is why most valuation models first project earnings into the future and then calculate how much this future value is worth in today's money. The present value of these future earnings is called the net present value, or NPV. For example, $1 today is worth $1. Easy. But how much is $1 5 years from now worth today? Well, if we assume that the average historical stock market return is 10% per year, this means we can invest a certain amount of money today to get that $1 5 years from now. How much? Well, if we take $1 and divide it by 1.10 to the fifth, we get $0.62. This 62 cent is the net present value of that $1 5 years from now. In other words, if we invest 62 cents today and earn 10% per year for the coming 5 years, our investment will be worth exactly $1 5 years from now. Check the colors to see where the numbers in the calculation come from. In our example, we assumed a 10% annual return. This 10% was then used to calculate the net present value. We call this percentage the discount rate. This discount rate has a strong effect on your intrinsic value estimate, so always choose a conservative figure. The higher the discount rate you use, the lower and the more conservative your intrinsic value estimate will be. If we would have used a 15% instead of a 10% discount rate in our example, the net present value would have been 50 cents instead of 62 cents. This is a 24% difference. The discount rate you choose depends on many factors. For example, which type of assets you invest in and how uncertain the earnings of a company are. But let's not overcomplicate things. If you are investing in stocks, a discount rate of 10% will give you a relatively conservative estimate and will work fine in most cases. So can we use the valuation models described in the How to Value Stocks ebook to calculate the value of any company? In theory, yes. However, the reliability of your estimate will be highest if you analyze companies with stable earnings, which are generally the companies value investors prefer. Seth Klarman said the following about this. Many businesses are so diverse or difficult to understand that they simply cannot be reasonably valued. Banks are a classic example of this. Because their financial situation is so complex that not even the bankers themselves know what their own company is worth. I therefore suggest to avoid these stocks like the plague. Another example of hard-to-value businesses are biotech companies, which often report several years of losses before making a massive profit once their product finally gets approved. There is just no reliable way to estimate the cash flows of a company like that. Again, you might miss some great opportunities by excluding certain stocks from your analysis based on the fact that they are either too complex or have unpredictable earnings. However, to give the floor to Seth Klarman once more, selectivity undoubtedly improves an investor's results. Investors who confine themselves to what they know, as difficult as that may be, have a considerable advantage over everyone else. Using spreadsheets is a great way to speed up these intrinsic value calculations. Therefore, I included a spreadsheet which allows you to calculate the intrinsic value of a stock using the 3 valuation models described in the ebook How to Value Stocks. Keep in mind though that spreadsheets and the exact numbers they spit out can give you a false sense of accuracy. Your assumptions and the data you input determine your estimate. Garbage in, garbage out. So don't blindly trust the outcome of your calculations. Always think before you act. Another easy way to calculate the intrinsic value of a company is by using the discounted cash flow calculator found under the DCF tab on gurufocus.com. To summarize, intrinsic value is simply a different word for absolute value. Every investor must learn to calculate the value of a company in order to know a bargain when they see one. There is no simple formula to precisely calculate the intrinsic value. It is always an estimate based on several assumptions, like future growth rates. Being conservative in your estimates is the only way to protect yourself from major losses. You might miss a few great opportunities by being conservative, but you will also avoid many mistakes this way. There are several ways to calculate the intrinsic value of a stock, and none of them is perfect. You should combine the results of several different valuation models and then lean towards the more conservative estimate. Book value does not offer an accurate representation of the true value of a company's assets. $1 today is worth more than $1 in the future. The present value of a future sum of money is called the net present value, or NPV. The imaginary interest rate used to calculate the net present value is called the discount rate. Some companies are too complex or unpredictable to value with any degree of accuracy. Spreadsheets are a great way to speed up intrinsic value calculations, but you should use them with care. Knowing how to estimate the value of a stock is just the beginning. We also need to minimize risk, which is something we will cover in the next module.